Hello, everybody. It is Macro Dashes. It is Thursday, May 26th, going into Memorial Day weekend. So I hope you all plant a flag or think of somebody or just kind of reflect on everything that Memorial Day is actually all about, which is baseball and camping, cooking out, and of course, remembering all the people who lost their lives for us to build the country and did all the hard work. To me, it's everybody who's helped make America a great place, even in the wake of another school shooting yesterday that really is just inexplicable to me. I can't pretend to know what the solutions are. I really have no idea. But it's just something that we need to find a way to stop somehow without being oppressive, right? That's the balance that we have to try to find, is freedom without tragedy. And hopefully we can do a little bit better than we have done to this point. So I wrote another article, and it was titled, Think Like the Super Rich. Think Like Super Rich Investors. And this is actually a Creative Commons picture, so I had to use it. You know, why wouldn't you want Dr. Evil with a big pile of money? So over at Seeking Alpha, Margin of Safety Investing, you'll find this article in the Getting Started section. I decided to put it here because I think it's that important that you think in a way that is different from other investors. And in fact, I have started another article like this in the past, and I didn't finish it. But it was basically the gist of this. In this one, I included kind of my asset allocation approach that I've talked about in other places. I'll be brushing up the Getting Started articles over time to make them a little bit more clear. But one of the questions I get all the time is, should I buy right now? What should I buy right now? And there's this urgency that people have to buy things. And I'll just tell you that that's the wrong approach to take. All the folks who try to use these little platitudes like, well, it's time in the market, not timing the market. Yeah, you know, stuff like that makes me want to swear. The reality is that, yeah, you want to be in the market primarily in equities for a long period of time and keep your money compounding. However, when it looks like you can actually take a 20 or 30 or 40, 50% or greater long-term loss, you should get out of the way. And the whole market is very correlated. What do I mean by that? Well, the S&P 500 is your beta of 1. That's your measuring stick. And if you take a look at the stocks inside of the S&P 500, almost all of them are close to 1, meaning that the entire index moves pretty similar to each other. So stocks anywhere in the S&P 500, when most of them go up, it's because they're all benefiting from inflows into the index funds and a lot of greed-seeking buying. And when they all go down, it's because people are selling index funds, and there's a lot of fear selling, a lot of panic selling. So most of the stocks in the S&P 500 will move in about the same direction as all the other ones and of similar magnitudes, with the exception, usually, there's one industry, one sector of the 11 big sectors that will outperform. And that is incredibly useful information. So when the stock market is going down in whole, when the S&P 500 is going down in whole, right, people use the stock market basically to say the S&P 500. When the S&P 500 goes down, usually utilities or healthcare stocks, occasionally, banking or real estate will outperform. But for the most part, it's usually, your utilities that'll hold up a little bit better. And in this last beat down the last couple of months, the pharmaceuticals have been holding up a little bit better. Those are your classic defensive stocks. People will say, well, what about consumer staples? And my whole thing with consumer staples is that they suck so bad most of the time that why would you ever invest in them ever again? Consumer staples haven't led for eternity because growth has been slowing for 15 years, and consumer staple stocks really only do well in huge expanding markets. So when you take a look at what the super rich investors are doing, you have to ask yourself some questions. And the first question should be is, do they chase the market? And the answer is pretty much no. Some of the hedge funds will chase the market because they're trading everything. They're trying to catch every trade. But most larger investors don't trade much. Why? Well, the answer is that they have so much money right? 1% of the population controls about 70% of the investable assets and 80 to 90% of the volume on the stock market in any given day. So if 1% of the people are controlling 70% or more of all assets and 80 to 90% of the inflows and outflows of the stock market, they can change prices. So they normally buy up the float when they can get it really cheap, and then they hold for a long time. And all that movement in the middle of the market is just a retail crowd running back and forth. This side of the boat, that side of the boat, this side of the boat, that side of the boat, this narrative, that narrative. I've had 3 people ask me, well, why is it going up right now? I laid that all out 2 weeks ago. I said we're still in a bear market, but in every bear market, there are bull market rallies. You use those to adjust your asset allocation to what it is you really want it to be. So for those of you who didn't accumulate a ton of cash in the fourth quarter last year and in January this year, these, what are sometimes face-ripping rallies, right? The market would go up, 8 or 9 or 10% in 2 weeks. Some of those big rallies, and that's a lot. People don't think of 7, 8, 9, 10% in 2 weeks as a lot anymore, which blows my mind because, that's, what we used to think of as a year. So when the stock market moves approaching 10% in 2 weeks, if it's going up and you think that the stock market is actually still in a bigger downtrend, and this is just a rally within the downtrend, because that happens, just like there's pullbacks in bull markets, those little cycles within the bigger cycles, you should ask yourself, do I want to trim something? And I will tell you, the small caps and the mid caps really don't need much trimming anymore unless you have some obnoxious asset allocation that you shouldn't have. Our starter positions are 0.5% or 1%. A half position, right, would be about 1 1/3% up to about 2%, or say 1.5% to 2%. And a full position would be like 3 or 4%. So if all of a sudden you have 9% of your money in some small cap stock because you just didn't handle the scaling in slow and small thing very well, and it rallies 90% yesterday, then maybe you cut it back to 4%. But in general, the correlations right now are this. The small caps are already beat to hell. The mid caps are mostly beat to hell. There's still some exceptions, but the mid caps got beat up pretty good. And it's the large caps, those S&P 500 stocks, that have held up. So which part of the market still has a ways to go to the downside as liquidity gets tighter the next couple of months? It would be large caps. Now, there are things that are just political realities. And I talked about for 3 months, 4 months, right? Starting in December, I told everybody, and going all the way up until the last couple of weeks, I was telling you, eventually, the Federal Reserve is going to back off. And I've been saying that the Fed would back off in September, right? Well, what was one of the headlines that I put out there for you to take a look at about a week ago? I think he said this the day after I told you again. The Fed might adopt Boswick's rate pause in September. So of all the people out there that forecast the Fed, I'm just going to tell you this. I don't sit around and just write Fed article after Fed article, but I follow the Fed pretty tightly. I know 2 people who work in Federal Reserve offices. We have some interesting phone calls once or twice a year. And a couple days after this, an article came out of the San Francisco Fed that said stagflation, right? Stagflation. Oh, wrong guy. Stagflation, which was something that I was talking about 4 years ago, for all the reasons in this article, is a risk right now. I talked about the tariffs, I talked about supply chains and oil, all in this article, and how because of what President Trump was doing and how China might react and what might happen if oil supplies got tight, and I talk about all that in this article, we'd end up with stagflation a few years down the road. I thought it was going to happen in 2020. I did. But then COVID hit, kind of blew a hole in the whole thing. Really what it did is it delayed everything by 2 years. So we are seeing the risk of stagflation right now because COVID basically delayed it and amplified it. So not only did the huge drop in demand prevent stagflation because nobody was buying anything except toilet paper, couldn't get enough of that. But then with all the money printed and the oil industry all goofed up, which I've showed you this chart too, which allowed Saudi Arabia and OPEC to cut oil production dramatically at a time when American companies were struggling to stay in business. So now we're at a point where globally we're short 1 to 2 million barrels of oil per day, and probably another 1 million to 2 million barrels because of Russia's idiocy in Ukraine. So we're 3-something million barrels a day short of oil. And the only way to fix that is to put out more oil, to drill more oil, or cut demand. Well, what articles are you starting to see in the press right now? Put into your article searcher leader, this thing called Google, and you're starting to see, I just saw it, an article that's on, I might have been Bloomberg, but basically said that demand destruction for gasoline has already started to happen because gasoline prices are so high. Demand destruction hits gasoline, but only a little, right, as prices spike up. When you take a look at the market, you have to just keep thinking all the things through. Don't ask, well, why did it go up this week? Because somebody like me, who doesn't always do a good job at holding their tongue, might say, who the F cares? It's just a rally within a bear market that we know for the next few months is going to get bombarded with liquidity getting taken out of the market and interest rates going up. But the Fed has now twice said in a week, maybe we'll back off in September. So they're really trying to micromanage this to get that correction in the stock market that they said they wanted. I've showed you those headlines over and over again. Fed said they wanted a correction in the market to pop the bubble, and they're getting it. But they don't want collapse, and they don't want people cashing in their 401k plans. So they're doing everything they can to negotiate with the market, the powers that be on Wall Street, for a soft landing. Here's the problem. The powers that be on Wall Street don't really think long term. They think about this year's bonus and how much they can make this year. So what can we see, right? What would we expect to happen? Nobody can tell you that. There's not a magic answer. But the fact that I've told you things that the Fed later came out and said like a week later, I think is probably evidence that we're roughly on the right path. We are heavy cash. If I don't own any, but if you still own large cap mutual funds in your 401k or whatever it is, if you own SPY, if you own the S&P 500 or VU, you need to sell those into these rallies. There's just so many stocks on the S&P 500 that are going to fall and take eternity to come back or never come back. Hundreds of them. Because the whole thesis out there that people suddenly have because they think they're smart, even though they've been wrong for the better part of 20 or 30 or 40 years, are trying to say that value is where you should invest in the commodity super cycle. Well, there are some things in commodities you want, and we talk about those. But the reality, and Buffett has talked about this over and over again, is a rock is a rock. A piece of metal is a piece of metal. What you want is a productive company behind those things, or the industries that use those metals and rocks and energy better than anybody else. Because as margins go up, the most efficient producers of whatever widget it is at the end of their company assembly line are the ones that win. So here's an example. With EVs, the companies that find the best battery technology and the best manufacturing process to produce their EVs a little less expensively than everybody else, but still be able to sell at about the same price as everybody else. And those companies with the better batteries, they may even use that to undercut the other companies just a little bit, but not as much as what they're, saving on the battery, right? If they save 50% on the battery, they're not passing that on to you. They'll pass a little of that on to you, just enough to get the sale. And then they'll pocket the rest. The ones with the best technology are going to win. The best assembly lines, the best manufacturing, the best robots are going to win. So you may really think a Lucid is cool, but if they can't produce it at the right price point, for whatever reason, the Ford Mustang Mach-E is going to kick their butt. Because we know they're way ahead on technology than almost anybody else. I think they are ahead of everybody else. Hard to tell, but I'm pretty sure they are. I just had breakfast with a U.S. Senate candidate yesterday. He showed up in a Mustang Mach-E. I said, whoa, you got a Mustang Mach-E? He goes, yeah, I had to wait for it, but I got it. And he said it's the coolest car he's ever had. He had a Tesla before. So take a look at that. So when you think about investing, you have to think about whole cycle, and you have to stop thinking about the idea the price is proving something to you today. All the price today is proving to you is that people are running to one side of the boat or the other. What you need to do is look at those charts that I put out on the VSL, the very short list, our watch lists of, 180 companies, 200 companies, whatever it is, and look at those charts and say, okay, I get it. And then pretty much stick with the plug and play stocks, because when I pick out the plug and play stocks quarter to quarter, I'm taking a look at relative performance, and I'm tightening up a lot of those ranges because who cares? And I might even get rid of the whole buy zone. I might just go with a bottom fishing price, because for 4 out of 5 of you, that's the only time you should be buying is if something hits a bottom fishing price, or if it's bounced off a bottom fishing price and then you get a pullback. Why? Because that's how the rich invest. Wealthy investors, and again, this is in the getting started section, aren't chasing the market. They buy on panic bottoms, and that rotates industry to industry. What panic bottom did Warren Buffett just buy? It's a company that we own. Warren Buffett followed me into another stock. Warren Buffett followed me into Apple. Apparently, they followed me into Amazon. They followed me into Store Capital like a quarter later, right? Liberty Media. I think we've both been involved in Liberty Media on and off a long time. So when I pick out stocks, I'm using pretty similar criteria to people like Warren Buffett and Peter Lynch, and to an extent, Cathie Woods, who I don't think is the greatest trader, but her ideas are basically right. And she takes a little bit more risk, but she hits a lot more home runs. As long as you understand that going in, you should be all right. And because she's in an ETF that limits her ability to trade in the first place, that type of risk management is left to you. You can't set it and forget it. The idea that there's a set it, forget it setting in the stock market is kind of a sick joke. I don't know who started it, but they must have recognized something with human psychology. And so they set it knowing they would probably stick. Well, I want to set it and forget it kind of thing. Yeah, it doesn't work. I mean, just think about all the things in your life that you do not set and forget. Your money shouldn't be one of them either. So in this article, I go kind of down the list. And one of the articles I mentioned, or one of the books I mentioned, is Reminiscences of a Stock Operator. Every single one of you should buy this book. If you have never read this book, it's an easy read. You knock it out in a weekend. But this is one of the classics of all time. It'll help you understand the psychology of investment. The ending of this book will blow your mind because it's the sort of thing that happens, tragically. So when you feel FOMO, you should really think about, if everybody else is doing it, is it the right thing to do? And the answer is usually no, except if you've already been in and everybody else is buying, you can hold on until they stop buying, then sell it to them, right? Buy low, sell high. So we bought Viacom up last year in the 30s. And who comes around buying it now this year? Warren Buffett. And we bought a bunch of satellite stocks between 7 and recently, 2. And yesterday, one of them doubled because the types of revenue streams that I told you were coming started to appear in the form of a $5 billion government contract that Planet and Black Sky both got a big hunk of. Buy low, it's a thing. And most of the stocks that I'm trying to get you into on the growth side, they pretty much all have 10-bagger potential. Doesn't mean it'll happen, but under perfect circumstances, a really good execution and a break here and there, some of them are going to be 10-baggers. A lot of them will be doubles and triples and quadruples, and a few of them won't execute, and they'll end up, lose half. For the most part, that doesn't happen to me too often. No, that doesn't mean that I'm not subject to volatility. The level of hate that we have allowed to permeate our lives, including our investments, is off the charts. I don't even know how you measure it. But if you do scale in very slow and very small on the front end, you don't get hurt too bad. I'm looking at my Spire Global. It is, of the portfolios that own stocks, let me get over here. Tell you right now what it is. Spire Global is a 1.5% position for me with an average cost of $2.15. It's $1.50 now. We bought it first at 7 and then $7.50 minus premium. So our initial purchases were up around 7, but they were small, teeny tiny. And I got some puts put to me recently at 2 and 3. So I have a cost basis all the way down at $2.15 with the premiums counted. I don't have to have it go up that much. Satellogic, same thing. Cost basis is $5.68. It's only a 0.5% position. But I do have a bunch of puts getting put to me at $7.50 minus $1.50, so there'll be $6 shares. So I'm going to end up with a 2.5% position in Satellogic and a cost basis of about $5.90-ish. And go up to Planet Labs. That's a 2.5% position already. My cost basis is $9. Then I wrote a whole bunch of calls. So about $8.50. on Planet. It's currently trading at $6. So the question to ask isn't, well, can it go down anymore? Technically speaking, a little bit, but it already got whacked. And Planet is the big dog in the group, hooked up with Google. Black Sky and Planet both got those contracts with the government yesterday or 2 days ago. So they need to know the companies. Don't ask silly questions like, well, can it go down anymore? Well, maybe. But if it's cheap, it's cheap. If you scale in slow and small, you're going to get an average price pretty close to the bottom. You know why? Because one of those purchases, hopefully the last one, the biggest one, will be at the bottom. Or maybe it'll be the second to last one. And then your last one is after it starts going up again. And that's okay. You can also wait, right? You can also wait, just monitor, try to be perfect. But here's the problem with trying to be perfect. It's not going to happen very often. You're not going to bottom tick many stocks. About 1 in 5 has been historically about 1 in 5 in my career, where I got lucky and I bottom ticked it, right? Got the, bought in at the bottom. It just doesn't happen very often. 4 out of 5 times, you're better off making 3 or 4 purchases, between buying stock and selling cash secured puts to get a price. As long as you know that it's undervalued, you're in good shape because you bought closer to the bottom than the middle or especially at the top. So again, you go back to Spire Global. I think it's a $20 stock all day in a few years. Started at 7, bought it all the way down, but pretty far apart. We didn't buy it at 6 and 5 and 4 and 3. You bought it at 7-ish and 3-ish and 2-ish. Big gaps. Had a premium in there too. And it was big premium because of the volatility. There's something called Martingale Theory, right? It's how numbers work. And I like to use blackjack as an example. So when people go to play blackjack, they think that if they double their bet every time they lose, they're just going to get back to even. Well, the reality is that's not true because there's 2 things working against them. 1, the game is rigged for you to be a loser 51% of the time. And 2, you're never going to play perfect. So most people double their bet. I'm out of money. Or they run up against the table maximum bet limit, depending on where you are. And you can lose 10 or 12 or 15 blackjack hands in a row. And eventually, you don't have the money to double your bet again. That's why with buying stocks, spread out your buys, start small. And I like to take a starter position and then sell a put out of the money because A, that prevents me from doing something dumb in the next month or 2, right? Click. And it spreads out my 2 purchases, net cost if the second one's assigned to me, by 20 or 30% generally. It's a pretty good spread, 20, 30%. And if there's a weird situation like with the SPACs where they go down way more than they should based on valuation, what's going to happen is you're going to end up with Black Sky and Spire and Planet, Satellogic at prices that in 3 or 4 or 5 years, you're going to look at and go, how the heck did I get these at $2, $3, $4, $5, and $6 a share? But you have to have the gumption, the emotional stamina, or what Sidney Moncrief called intestinal fortitude, or maybe it was said about Sidney Moncrief because he got fouled so hard so often. The intestinal fortitude not to sell because something is down for a year or 2. Just keep following the business. Read about the businesses. And I'll tell you this over and over again. If you're going to invest your money, your hard-earned money into a company, read the company's presentations. I'm not telling you to read an entire 10Q or 10K, although that would be good. I do it for you. It's where the ideas come from. But at least look at those 20, 30, 40 page glossy PDFs with the pretty pictures and charts so you understand what the general business model is and what they're doing to execute on it, because that'll help you sleep at night. Information is better than a sleeping pill. But one of the other things I put in this article is kind of my idea of asset allocation, right? So my asset allocation is something along these lines. You've heard of the 60-40 portfolio, which is 60% equities and 40% fixed income. And that worked pretty well from the early 80s after interest rates spiked, after Volcker spiked interest rates. And we got basically a 40-year bull market in bonds because interest rates just came down from the upper teens to 0 over 2 generations. Well, in the last several years with interest rates skipping along nothing, the 60-40 portfolio started to trail. And now with interest rates going up, you especially don't want to own bonds. Now, there's going to be a trade here in TLT soon because interest rates will start to come back down later this year. But it's just a trade. You won't want to hold on to TLT. The yield's going to be like 1 or 2%. Who cares? 3% on the high side for a minute. and then it'll come back down to 2. If we have a recession, go back down to 1, right? A post-stagflation recession. So I break up my portfolio really into 3 pieces. I have my position trading side. It's about 60% of my money, sometimes down to 40, depends on how the covered calls work, how the cash secured puts work. But around half of my portfolio is position trades. These are stocks that I never want to sell completely out of. Now, I might trim along the edges or add a little here, right? Like somebody told me they sold half of their black sky yesterday. That's a bad idea unless it was too big of a position. Now, you wanted to, trim, 10 or 20 or 30% of it just to lower your cost basis. I get it. But if you were still below your cost basis, I don't know why you'd bother selling. Just because they had a big move, big deal. Black Sky and Spire are both going to be multi-billion-dollar companies, and they're priced in the hundreds of millions right now. Same thing with the Metas. I love when I can find companies in the hundreds of millions that I know are going to be worth billions. It doesn't even matter how many billions. From hundreds of millions to billions, you're looking at least 4, 5, 6, 7 times your money. And sometimes 10, 15, 20, 30%, 30 times your money. And if I knew which 6 stocks were going to do that, I'd only own 6 stocks. I'm good enough that I only have to own 20 to 30 stocks. And I will tell you, in a lot of client portfolios, I'm getting down to a dozen stocks and then just dealing with half, with the ETFs, the 7 or 8 ETFs that we use. Because broad diversification, as Warren Buffett has said over and over again, is for people who don't know what they're doing. And if I didn't know what I was doing, I would go sell solar panels or battery technology or something that's on this huge secular growth trend, and I would just buy QQQ and dollar cost average into it forever. And for those of you who give up on managing your money at some point, and my experience is that about 1/3 of you will, that would be my advice to you. Dollar cost average into QQQ or something similar like IETC or whatever for a super long period of time because it'll outperform, and buy some REITs too. That's it. There is a very simple approach to investing that most people don't do because they think there's so many things to do. No, 80% of the ideas out there are junk. You should treat them as junk. You should put them on the curb and never think about them again. Hopefully the raccoons don't get at them. So around half of my money, personal money, is in position trades, stuff that I'm really just not going to do much with. Once I get in, I'm looking at owning these for years. Every now and then, one of them, goes up a ton fast, and I'll trim it. The second piece of my portfolio is cash. And it's the money that otherwise people would put into bonds. I have a visceral hate for most bonds. The only time I've ever made money in bonds is after a major correction, like 2008 or 2020, where you could buy corporate bonds and convertible bonds that were broken, right? They would never convert. But you'd have these ridiculous interest rates like 17, 18, 19% for a minute because they were trading at 40% the par, 40 cents to par. And you knew, well, this is an easy double. It'll go from 40 cents to 90 cents pretty quick once the world isn't ending. So then the world stops ending. Bond goes from 40 cents or 30 cents or 50 cents up to 90 cents. And then you start seeing the articles, you got to buy this bond. It's going to go from 90 cents back to par. Where were these idiots when I was trading at 30, 40, 50 cents? That's the only time you buy bonds. Ben Bernanke, a long time ago, after the financial crisis, got interviewed or had lunch with David Einhorn, a bunch of other hedge fund guys. And Einhorn asked him, when do you see interest rates normalizing? Ben Bernanke, in his 60s at the time, maybe in 70, 71, 72, said, not in my lifetime. Dude's still kicking. Normal long-term interest rates are around 5% on U.S. Treasuries. And we're squeaking with them sniffing 3. They're almost to the top. Why? Slow growth forever. Keep coming back to that thesis. Slow growth forever. Demographics is destiny. And soon demographics and robots are destiny. So that 40%, 30%, 20% that I'll have in cash, been closer to 40 lately than 20, I'll write cash secured puts against. I'll try to find volatile small caps and mid caps that I really like the businesses, but the market doesn't appreciate. And the traders are pushing way up and way down. And when they push them way down, I'll sell the puts. And if it gets put to me, that's fine. I just had a huge premium. I own something I like cheap. And when it goes up, I'll sell a covered call and I'll trim it. The last part of my portfolio is 10 to 20% of my money is in swing trading. Now, it's been a little bit more lately, but it's normally closer to 10% than 20%. So this portfolio really is more like a 60-30-10 but these are the ranges. And if you're good at technical analysis and you have taken the time to learn some things about swing trading and understand that it's mostly technical driven in the short term, go ahead and swing trade 20%. You better be good at it. If you're not good at it, just skip it. People over at Fundamental Trends that are swing trading have all put some time into it. I can tell because I've watched them on the bulletin board, and their questions have gotten better over the last year, and a lot of that's due to Shooter. But I can tell that they've read, I can tell that they've studied, and they're making an extra, hunk of money every year against a small part of their portfolio. Now, some of them I think are trading more than 20% of their money. And the only time you should really do that is if you have an income and you're constantly dollar cost averaging into your position trades. But 10 to 20% of your money for swing trading is A-okay, but you have to have some education, and you have to have a method, and you have to have an emotional mindset that allows you to say, well, in the long term, I want to own this, but in the short term, it's acting shitty, so I'm not going to add any, right? And the satellite stocks are another good example of that. It was very hard to trade them lately because they just were acting bad. And I wouldn't short them because I knew that any day they could get a contract to send the stocks up double digits, blow up my short trade. And it just happened. So people who were shorting the already beaten up satellite stocks, they deserve to get their ass kicked for shorting them because those are just bad trades. They didn't understand the business. Where I will generally swing trade is in ETFs. Why? Because an announcement won't usually blow me up, whether it's a good announcement or a bad announcement. So I almost never swing trade stocks. That's me personally. If you want to try it, then my advice to you is if you're going to short a stock, only short shit stocks. And if you're going to trade long, only trade great stocks long. Ignore the middle of the market there too. Why do you only short shit stocks? Because the announcements are going to go negative most of the time, and that'll make your short better. And with great stocks, you only go long on great stocks like Apple and Microsoft. You should never, ever short Apple and Microsoft. I don't care. If you're doing that, you're an arrogant fool. And I'll tell that to anybody. Never short a great stock. Why? Because the announcements, the surprises are generally positive. I mean, you can get lucky and catch a bad one here and there, but why would you try to do something so hard? There's hands in poker where I know that I'm the better player and I have decent cards, but I'm against some sort of a landmine, some guy who's going to make a bad call or bad bet, and I'm going to get involved in a hand that's just way bigger than what I want to deal with based on what I have. I was talking about poker with one of my friends who took 10th in the online main event. I mean, that's pretty damn good. Luckily, I had a piece of his action. And he says, look, when you're out of position, look for reasons to fold. When you're in position, look for reasons to play. Well, with stocks, what that means is if you know the company well enough and you know that in the long run, it's going to do pretty well, you can trade it to the long side in the short run. Why? Because even if it goes down for a little while, you know that the long run is going to bail you out, right? Why don't I buy Exxon? Even though I do think that the activist investors have saved them, right? Before the activist investors came into Exxon, I thought Exxon was headed for a bankruptcy. Engine Company 1 saved Exxon, changed their whole business model, changed their executive compensation, all the things that I complained about with Exxon, they're changing. The next thing they're going to do is push them into hydrogen. Chevron's already ahead of them on that. And you'd think they'll get into carbon capture. I'm still shocked they didn't lower the dividend. I think they missed their opportunity to do it. So now they have to take a different financing approach to what they're going to have to accomplish. If they're smart, they don't raise that dividend hardly at all the next 10 years, like a penny a year, just to keep their streak intact. But I never bet on Exxon going up because I knew the secular trend was down. Now they're just an ignore for me. I just ignore Exxon. I don't bet it either direction. Why? Secular trend is down, but the new management is pretty good. They're probably going to grind it out. The dividend as a percentage of the revenue is going to stay about the same, which means that the debt's going to take a long time to pay off, which means that they can't add to the dividend. And once the price of oil starts going down middle of the decade, sometime next 2-3 years, they're not going to have as much cash to throw off. So maybe they do have to cut the dividend someday. They'd be smarter to buy back shares. Why? Because if you buy back shares, there's fewer dividends to pay because there's less shares to pay the dividend on. All those things apply to a lot of companies in the S&P 500, which is why you should not own the S&P 500. You don't find a lot of super wealthy people that own the S&P 500. They literally have stock portfolios of a dozen stocks, maybe up to 30, but usually closer to a dozen. And the family office money managers I know will buy a couple sector funds here and there, industry funds. They don't own 2, 3, 4, 500 things, exposure through ETFs and, a 50 stock portfolio. So for the people who have 40, 50, 60, 70 stock portfolios, I'd ask you this. How the hell would you keep up with that? Seriously. How can you know what's going on at 50, 60, 70 companies? I use an artificial intelligence and a bunch of services to keep up with my very short list. And I fall behind all the time. And when there's a technical move, then I look it up. I look up, what's going on here? Because the technical moves will alert you to something is changing sometimes. Other times, it's just change in liquidity. And as I've told you, changes in liquidity, as Jeffrey Gundlach, as Buffett, as Lynch, as they all tell you, Paul Tudor Jones, all the big traders, George Soros, all these guys tell you over and over again, they're in the headlines all the time. Jeremy Grantham, Brandis when he was a big deal, Templeton when he was a big deal, when he's alive, the people from the Mutual Shares series, right? All the Michael Price disciples. Changes in liquidity are where the markets pivot. So we're seeing that right now. And because most money is in large caps, those are the ones that'll get hit by the liquidity the most. And when that's done and over with, sometime in the next few months is my guess, might be a couple different waves down and up and down and up and down, and then finally back up, right? The small cycles within the big cycles. This bear market could clearly last towards the end of the year. I don't think it will, but it might. So we go slow and small. We focus on the things that we think are the best, and we don't say things like, I think, if I could get Home Depot at 3% dividend, I'd be all right with that. No, drive a harder bargain. Drive a harder bargain, because the stock market's never going to give you a break. It's trying to take your money. Be a bottom fisher. Look for great deals, not good deals or okay deals. If you're going to pay for me or anybody else, you're looking to beat the market with less risk. And if you're doing high dividend yield strategies, you are not taking less risk. And in fact, because you're losing so much growth, you're not going to beat the market. Those high dividend yield strategies take as much risk as the stock market and don't beat it. Why the hell would anybody do them? If you want to make high single digits, keep your money 100% in cash, sell cash secured puts on the bluest blue chips, and just rinse and repeat for 3, 4, 5 times a year. And you'll make high single digits. And the worst thing that could happen to you is you'd end up owning Apple and Microsoft and Google cheap. Would that really break your heart? No, but I got 7% dividend on this one over here. And then it drops 40 or 50% because it has no growth, it has debt, and their business model was tenuous to begin with. And that is the story behind almost every high yield stock. There are very few that don't fall into that category. I was in CenturyLink, which became Lumen Technologies, and all that's done is drift down from 20 to around 12 and chop around and been through a dividend cut. Is that company going to do all right someday? Probably, but why would I deal with that? You only need between 12 and 30 stock ideas. So you out of 7,000 or 8,000 in the stock market, right? You need a fraction of 1% of the stock market in your portfolio and a couple of ETFs, several ETFs, get a whole, focus on secular trends that are in your favor. But with 12 to 30 stocks, you should never take an okay deal. If you look at something and it doesn't say it can blow away the market, at least for the sector that it's in or the category that it's in, don't do it. None of them do. All right, let's call it a day.